To take a deeper look at what is moving markets, I want to bring in Matt Stuckey, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. Matt, great to have you on the show today. And certainly we've seen some of this momentum kind of evaporate from the market. What's your take?
Yeah, well, good morning, first of all, Kristen. Thanks for having me on. Look, I think this morning is a little bit of a momentum unwind. And the catalyst for that unwind was Meta's earnings last night. You touched on it a little bit with your opening comments, but the quarter itself was fine in terms of the execution, the ongoing revenue generation and profitability of the organization. It was that second quarter guidance, which is where some of the commentary from Mark Zuckerberg about demand trends, as well as what they're leaning into on the AI investment side of things, really spooked investors. And to put a little bit more context on it, revisions have been moving higher for Meta for the last year. If you were to look at investors' expectations for what type of earnings 2024 held for Meta a year ago, it was roughly $10 a share. And those expectations doubled in the last 12 months as cost-cutting initiatives that Meta undertook bore some fruit in terms of profitability. You had Reels monetization, AI engagement tailwinds, as well as Chinese advertisers re-emerging in terms of putting their demand for Meta's products first and foremost into their business plans. And so what changed was a moderating revenue picture for Meta, as well as a higher expense profile. And what that does, Kristen, is it starts to top out earnings expectations for the rest of 2024. And so they're no longer rising. And that's really a critical input for a lot of investors. They want expectations to continue to be stable or rising with the positions they have in their portfolio. And really, this was kind of a change in the other direction, which is why you see the stock reaction that you see this morning.
Interesting. So on top of that, we did get the GDP report out this morning for first quarter growth, Matt, and that did actually vastly underperform 1.6% U.S. GDP growth. Economists had expected growth of more than 2%. Yet we recently heard from the Fed that inflation is sticking. It'll have to keep rates higher for longer. How does this GDP report factor into where we could be headed for the economy and thus the market?
Sure. I think, this report this morning was another indication that inflation is still sticky out there. And unfortunately, what that means is that the Federal Reserve is likely to be on hold, and those rates that we see that are higher today are likely to be higher for longer. Just 4 or 5 months ago, investor expectations were at a level where 6 rate cuts were expected in 2024, and now investors aren't expecting the first rate cut to happen until December of this year. So, we're talking about a complete change of expectations in the form of kind of what type of monetary policy accommodation the Fed might be able to create this year. And what that means is that this just allows more time for higher interest rates to work themselves into the U.S. economy. That's a downward pressure on U.S. economic growth. We didn't really expect it to show up this first quarter. We expected it to kind of show itself more in the second half of this year, but based on the report this morning, it's already starting to have an effect. That just starts to weaken a little bit of the U.S. growth story and is likely to cause some more volatility in the equity markets.
What would you advise to clients right now?
Look, I think in volatile environments, diversification is your friend. Diversification across asset classes and within asset classes. The U.S. stock market is very concentrated by historical measures. The top 10 names in the S&P 500, as an example, represent more than 30% of the weight of the index. We think that diversification is probably where you want to be, kind of given that level of concentration, and a little bit of unsured, difficult areas of kind of where the U.S. economy is starting to struggle a little bit, based on this GDP report. So, things like high quality fixed income resonate to us here, where we're seeing kind of really attractive real interest rates. some of the highest we've seen in 20 years. That's a defensive part of your portfolio that can help to kind of create a ballast in one's portfolio during choppier waters. Additionally, there's other areas of the equity market that are quite a bit cheaper than what we see in the Nasdaq or in the top 10 of the S&P 500. Those are other areas to lean into in a portfolio if you're looking for diversification. So all areas, when you combine it together, to us, is where you want to lean into, and keep a long-term time horizon absolutely for what's in store for the rest of the year.
So walk us through, Matt, what could be in store for the rest of the year. Obviously, rate hikes still to be determined whether or not we get them. But do you think that this sell-off, I mean, the Nasdaq is getting close to a 10% pullback now. That would technically be a correction by market terminology. Do you think that this sell-off in some of these large cap names can continue?
Well, we're right in the meat of the earnings season right now with companies like Alphabet and Microsoft to report after the close, and so if those reports disappoint, similar to what Meta reported after close yesterday, you're likely to see downward pressure continue, since there's just such significant weights within that index. In terms of kind of what's in store for the rest of the year, our thesis is still unchanged, that we expect these higher rates and the Fed's inability to cut them to ultimately result in a mild form of recession. The Fed's track record in landing soft landings is pretty dismal, and unfortunately, we do expect at the end of this cycle the end destination to be the same.
Mm-hmm. How many rate cuts are you forecasting this year if we do get any?
Well, unfortunately, if you look at the history of rate cuts and Fed cutting cycles, typically you don't see just one rate cut, two rate cuts here and there. Usually when the Fed cuts, it's in response to something that's starting to develop within the economy that is concerning. Usually when they cut, it's 100 or 200 basis points because they're responding to a deteriorating macroeconomic situation. We don't want to sound the alarm bell today, and because that's not what we see happening in the U.S. economy. But if the Fed can't cut and they're too late to begin cutting because inflation's sticky and they can't cut, ultimately that's the type of rate cutting profile we would expect to see maybe later this year, but at some point in 2025.
All right, Matt Stuckey, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. Matt, thank you.